Hello, investors. Welcome to Proceemo. Today is October 31st. Happy Halloween. Is today's stock a trick or treat? Stay tuned to the end to find out. This week's featured stock on Proceemo is Microsoft. Every week, Proceemo features a free stock to analyze. Head over to proceemo.com to see exactly what I'm showing you today. Everyone knows Microsoft for Windows and their Office suite of products like Word, Excel, and Outlook. Some might know them for their gaming business, the very popular Xbox gaming console, but another potentially lesser known and very lucrative business for Microsoft is cloud computing. For those who don't know what cloud computing is, this is when Microsoft's customers leverage Microsoft to run their business's software instead of the customer having to buy and maintain their own infrastructure. So for example, Proceemo.com is a web service that runs in the cloud. I do not own the server that runs Proceemo. I simply pay a company and borrow a tiny piece of their infrastructure to run the service on. So if we take a look at our segmentation pie chart, enterprise and cloud services are actually the biggest slice, coming in at 34% of Microsoft's business as of their last earnings report in June of this year. That 34% equals $67 billion of the nearly $198 billion Microsoft generated in the previous fiscal year. Not too bad, right? And much like the rest of the market, Microsoft stock is down from roughly $332 a year ago to about $235 right now. That's down 29%. Where does this leave Microsoft? Well, let's start with my favorite metric, implied growth. Implied growth is a calculation that tells us how much growth is baked into a stock at its current price. Now, there are a lot of ways to calculate implied growth, and we'll cover Proceemo's model in a future video. Today, the focus is on Microsoft. Microsoft's implied growth at today's price is about 8.44%. Let's take a look at how that compares to their actual growth over the past couple of years. And wow, it's pretty far off actually. Microsoft's revenue growth between 2021 and 2022 is almost 18%, and their earnings are well over 18% at 18.72. This is a really great starting point for any value stock investor. However, you shouldn't just look at the previous year. Let's look at the years prior. 17.53, 13.65, 14.03, 22.69, and 5.43. Microsoft's revenue has more than doubled since 2017, and its earnings are even more impressive. With implied growth currently at its rate of 8.44% and actual average growth well into the double digits, this initially looks like a really great value. But implied growth is just one factor. Let's take a look at the scorecard. So as we said, implied growth looks good, and our implied growth over 5-year average growth is about 0.23. At a value of 1, we would say the stock is fairly valued. Over 1, we would say the stock is overvalued, and less than 1, we would say the stock is undervalued. By this indication, Microsoft is well undervalued right now, which is crazy to say for a company with a market cap of over $1.7 trillion. Next on our scorecard is debt to asset ratio, which comes in at 0.54. No concerns here. Anything under 0.6 and over 0.3 is pretty normal for the industry. Steady dividend. This is a favorite indicator for the cash flow enthusiasts. In fact, if we take a quick look at our dividends, Microsoft was paying 51 cents a share in May of 2020, and now they're paying 62 cents. That's a 20% increase over the last 2.5 years. We love that. Back to our scorecard. Our long-term ability to pay that solid dividend is also strong, with an operating cash dividend ratio of 4.91. Generally, anything over 4 is a really good indicator, and Microsoft is nearly at 5. Our market cap to revenue ratio is 8.52. This is sometimes known as the revenue multiple. 8.5x in tech a year ago would have been strongly underperforming, but today in this market, this is pretty average because of the current macroeconomic conditions. We have 5 years of increasing revenue, which is always a really great, strong sign. Assets greater than market cap is not the case, and it's usually not for tech companies. This is not a negative indicator in my opinion, and in general, this being true is kind of rare. Next, we have 3-year average revenue growth being greater than 10-year average revenue growth, and yes, Microsoft checks that box. Increasing revenue growth for 3 years is false. This is really tough for a large company like Microsoft. And while Microsoft has increased its revenue year over year, its growth rate for 3 years ago was slightly less than the year before. If we take a quick look back at our revenue growth over the last 4 years, not a huge deal in my opinion. 5 years of assets greater than 1.5x multiple of liabilities. This is also false. This is a really rare attribute that we've pulled directly out of The Intelligent Investor by Benjamin Graham. This is a really strong indicator for a highly valuable company. And more times than not, especially in tech, it's not true. And that's okay. And finally, revenue per employee at almost $900,000. There's no magic answer here as to what a good value would be. Generally, when I see this multiple higher than the average employee wage, I think that's a very positive sign. I don't know what the average Microsoft employee makes, but even if it was at $300,000 fully baked, this looks really, really good to me. So overall, Microsoft checks a lot of the value fundamental checkboxes. The downturn in the stock market is making some companies look like exceptional values compared to years past, and Microsoft is a pretty good example. Now, even though this looks pretty good on paper, our philosophy at Proceemo is that numbers are only 50% of the equation. The other half is the story. What's Microsoft's story? What does their future hold? I personally think Microsoft has a bright future and will continue to execute, especially in the cloud. Large enterprises that bought into Microsoft's ecosystem 2 decades ago are still bought in and migrating a lot of their services to Microsoft's cloud. Microsoft's biggest competitor in this space is Amazon, AWS, Amazon Web Services. And even though Amazon is a little bit bigger, many of the large enterprises today are actually looking to provision cloud from both Microsoft and AWS as they build out a multi-cloud strategy for their businesses. That's it for today. Please like and subscribe if you found this helpful and valuable. If you really want to support the channel, please go to proceemo.com and subscribe to our monthly service to see analysis like this for all of the stocks that you follow on a daily basis for only $5 a month. If you have some suggestions for next week's featured stock, please leave a comment below and we will take that into consideration for our future featured stocks. Thank you. We'll see you all on the next one.